How's it going, everybody? Today we are going to be talking about the three most common mistakes ICT traders make. These are mistakes I've made, and the reason I'm making this video is because I wish I had a video like this when I was just starting out. Because what it could do is it could potentially open your eyes if you're not even aware you're doing something incorrectly, and if you're just having a tough time trading. Maybe in this video I identify one of the three, or one of the things that you're messing up in your model, and I can clarify how to fix it. Because I'm going to be going over the solutions to some of these common mistakes I see amongst a lot of traders as well. And let's get into it. Also, I fixed my mic. A lot of people said it was quiet from last time. I thought it sounded alright when I listened back to it on the recording, but I boosted it up for this video. It's actually touching the yellow in OBS, so I hope it's not too loud. But let's hop into it. The first common mistake I see a ton of beginner traders make, and it's something I used to do as well, is that we're simply starting off on the low time frame and we're kind of pattern trading. I call it the 2022 model Cannon event. All right, I used to do something super similar, and all it is that we are not acknowledging anything else externally, what anything at all. We're stuck on our low time frames, maybe our 1 minute, 5 minute. Maybe we'll check the 30 or the hourly if we're feeling cheeky. But we are completely ignoring everything because we want all of the action on the low time frame, right? We love all of these ups and downs. It's very stimulating, right? But without knowing what we're looking at on the hourly time frame or some of our higher time frames, it makes us super hard to understand what type of price action we're even in. What's the overall trend? What direction are we going in? Do we even care about a trend if we're trading like this? And the answer is probably not. We're kind of just pattern trading. A lot of traders think that you can just trade a system like the 2022 model whenever you see a liquidity sweep, breakup structure, fair value gap sort of deal. This is not how you should be trading. This is pattern trading. It's no different from a head and shoulders pattern or retail patterns you guys love to make fun of. If we're just firing off random internal executions with no narrative, there is no difference from pattern trading like a head and shoulders to what we're doing. So we need to differentiate an entry model and kind of a bias. There's two steps. A lot of traders and a lot of content creators will only show you the entry model, like a 2022 entry model, unicorn entry model, inversion fair value gap model. These are entry models, meaning something has to precede the entry model to determine if you want to go lower or higher. Without this, we are going to be completely oblivious to what we're trading. And sometimes it will work out in our favor, yes. Sometimes it will not. We need to differentiate what is going to work and what's not going to work. And we're going to do that by implementing our high time frame. Okay? As you guys know, I preach this all the time. It's pretty much the bread and butter of my system. And I'm not going to go too in depth into the key levels and SMTs in this video because I have an entire video dedicated precisely to understanding bias and um, how I use these key levels and SMTs for my own trading and in my own three-step distribution model. But we always have to incorporate a high time frame, right? Instead of just blindly pattern trading on the low time frame. So starting off every single day, you can literally do one of two things in the market. You can go up or down. We need to figure out which of these two it's going to be. And yes, you can chop around. That's important. We're going to get to that later. But trading my three-step distribution model, you really only catch one of two. You very rarely get caught in chop. It happens, but very rarely. So you need to find a high time frame bias and align it with your entry model. Again, it's an entry model, not an entire model. You have to get a dictated narrative to then take that entry model. So in this example, we have our key level and SMT to identify our manipulation. I identify key levels as high time frame highs or lows or areas of liquidity we sweep out to give us a really high probability manipulation. And then I just pair that with an SMT for an extra confluence. Right? And again, this is on the high time frame. This isn't just random internal liquidity, maybe that we think is significant, but it's on the low time frame, so it doesn't matter. This is the high time frame, so it's going to trump everything. This manipulation is going to tell me that we want to go lower because we distribute away from the manipulation. So we've solved the problem of which of the two directions do we think price is going to go in just from using a key level SMT. So we know we want to distribute lower. Now that we have this understanding, price wants to go lower, this is where we use our entry model and we align time and price. I'm not going to get too deep into this super fancy stuff of how I trade the time frame alignments and all that stuff, because like I said, I have videos on that. That's not what this video is for. This video is to just explain and to identify what you guys could be doing wrong. So like I said, now that we have this, And this understanding that we've manipulated here and that we want to distribute lower, now we can look at our low time frame and align this, right? And I'm not gonna get too fancy into the mechanics of it, but here, what we see a liquidity sweep, and then again, let's start looking at all of our entry models that now align. Now that we A, have our manipulation, and B, we have our internal manipulation. And also, this is from the hourly open, high, low, close, because again, we're anticipating a bearish hourly candle. So we want an open, high, low, close. Not what this video is for, just thought I'd tune it in there. So we manipulate higher. Now we have an internal manipulation. And look what we have. We have an inversion fair value gap. All right. We have our break of structure. We have our fair value gaps. Now all of a sudden we can start to take our entry models, right? Because we've aligned our high time frame bias with our low time frame entry model. And these two things have aligned to give us the direction that we're trading in. So you see how instead of just guessing and pattern trading, any liquidity sweeps or, whatever we see in here, we've got a system where we align these two things. And again, that was super quick and sped up. I have an entire video dedicated to that. Go check that out in my YouTube channel. But this is going to directly lead us into the second problem. So we've solved the first problem of we're just pattern trading internally. The second is a lot of ICT traders don't know how to use these fair value gaps. Which ones do I choose? Which ones are breakaway gaps? Truth be told, I think fair value gaps are too random for me to trade personally. I've kind of eliminated the fair value gap from my arsenal as an entry model purely for that reason. And how can we really know if we're going to retrace here, if we're going to retrace deeper? To me, all of that randomness was not something I wanted in my system, and I just liked the consistency of the change in state of delivery entry that I take. Super straightforward. It happens all the time as it's a confirmation for my model on the open, high, low, close, so it's necessary. It gives us all the confirmation we need. Why do I not just simplify this and take the CISD? But for those of you that do take fair value gaps, what I will say is that A, the directional fair value gaps aligns with the high time frame bias. So it's kind of like taking out two birds with one stone here, is that the high time frame is going to trump all, right? You see how we are distributing lower, and we are now invalidating our bearish gaps, and we're going to be respecting our bullish gaps because of our high time frame bias. So in terms of determining which directional fair value gaps you use, if you want to use bearish or bullish, that's where you use that high time frame, and again, you stop pattern trading internally. So it's kind of like a 2-in-1. As for which ones to trade, it's difficult because it depends on your model in a way. The reason I cut out fair value gaps for my model is that my 3-step model is a 3-step distribution model. Distribution means you are going to have a very quick and volatile move down. That doesn't mean you're going to slowly chop up, retrace, chop up, rebalance, It means you are going to shoot down super quickly because we've timed our manipulation and we can anticipate a super quick distribution in alignment from this manipulation. So that's why I've eliminated fair value gaps for me, is because it doesn't make sense if I'm trying to catch a quick distribution for us to retrace in that distribution. That's not what a distribution is. Sometimes, yes, we do get our rebalance, and I call it a first stage distribution when you retrace to the area where we got our change in state of delivery and we get like a unicorn model, but it's just too inconsistent for me to trade. I've eliminated them. It's something you guys could consider. A lot of people think the fair value gap is like a necessity on an entry model. It's really not. I mean, fair value gaps are crucial for me because I still use them on the high time frame. I use them as a key level, which you guys will learn about in my other bias video if you go check that out, which I suggest. But what I will say is that you can technically fire off any of these random internal gaps in here. Oh, that's my highlighter, sorry. You can absolutely fire off any of these random gaps, and you can set limit orders here once you understand how to identify internal protected highs. So this is an internal protected high because we swept out this hourly or this internal high, and we put in the high of our hour. This has to do with the open, high, low, close. Again, I'm not going to get too deep into what that is because that's not what this video is on. I have another time mechanics video on the YouTube channel where I describe how to implement and align time. Once you identify your invalidation points, this is an invalidation point, meaning this is your guaranteed stop loss. you can fire off any of these fair value gaps of your choice with a super solid stop loss. Now, obviously, with that being said, it's going to leave you with some not great risk to rewards, but if you guys are set on trading a fair value gap, you can absolutely trade gaps with stops set at these internal protected highs and lows, which are just the manipulations for your open, high, low, close, and how you're determining an area where price should not retrace to. And if it does stop you out, oftentimes you just got the trade wrong and it's going to go higher, right? So you absolutely can fire off these gaps. Again, I do feel like there is a little bit of randomness to choosing all of these 1 minute gaps, and that's why I've just strayed away from them. Why am I overcomplicating trying to find the perfect gap in, giving myself or allowing myself to introduce more variability into my model when I don't have to? That's why I've simplified it to a change in state. Forget, trying to get all this and maybe have inconsistent risk to rewards or all that stuff. I've just eliminated it, right? So think of that. Again, I'm not trying to get you to completely change your model. Just think on it. And finally, the last mistake I see a ton of traders make is that we're trading in terrible price conditions and we don't even know it. Okay? And the reason we don't even know it is because as New York session traders, you guys have the predetermined thought process that 930 open equals a lot of volatility, which equals best price action. Incorrect. That could not be further from the truth. You have to look at what happened in the previous session to determine what type of price action you're going to be seeing in the New York AM session. There's videos on what's it called? Daily profiles and session profiles and stuff that could help. I don't use it. I think it's overly complicated and it will just confuse you, so I don't implement session profiles into my trading. But you have to think of this logically. If we sold off 150 points and we wiped out every area of liquidity to the downside before the market even opened, do we really think price is going to just continue to be super volatile? No, we need to reaccumulate, and you'll see after we reaccumulate what happens. PM session then gives us a distribution, right? So we have a manipulation up here, I'm assuming. I'm not going to take too close of a look at it. We distribute, and then we accumulate. And then that gives us another manipulation here to distribute higher. And it's following this AMD framework. Accumulation, manipulation, distribution. And this is fractal, right? This is basically the outline of my model. The three-step distribution is that you're identifying the manipulation on your hourly or 4 hourly to catch the distribution. This applies to the high time frame and just price action in general. If you've distributed, which doesn't happen, well, I mean, it doesn't happen. So you're not going to catch a distribution. So as a New York AM session trader, if you see price sell off a ton before the pre-market, do you really think you're going to have good price action? Probably not. Okay, probably not. And if you see price accumulate before New York session, or this isn't even a New York session, same thing happens here. Actually, this is pre-market, or I guess it's kind of like 930, but accumulation, distribution. Do we think we are going to have really good price action for the next 2 hours after we have a massive, what is this? A 230 point sell off? No. No. And then what we're doing is that we're FOMOing on this massive distribution, and then we're getting obliterated by all of this internal price action. You really just have to identify this and say, bummer, I didn't understand why this sell-off happened. I've just got to live with that. I can't get caught in this chop. I cannot allow myself to FOMO and then trade an improbable price action. You're just going to get cooked, okay? It's just how it goes. Sometimes that's how it works. 9:30, the price sells off. There's nothing we can do for AM session. Very brutal, tragic. I know. We just have to close the chart, go about our day. We go touch some grass. And another thing is that why are we trading bad days for news, guys? I stream a lot. Why are we trading 30 minutes before NFP? We don't have to do that, guys. We can go to a website called Forex Factory, and we can identify high impact news based on the red folder and the USD for indexes, and we can determine if there's going to be a high volatility news injection into the market, meaning we're just going to get one of these massive distribution candles. like a CPI pop or a PPI pop, and we shouldn't trade, right? Like this might have been news. I don't know. I don't know. Maybe it was NFP. Yeah, this was NFP because it was Friday the 7th. We're gonna get caught in a massive news candle like this. Why would we trade pre-market on a day where we have NFP at 8:30? Again, it's following the same accumulation, manipulation, distribution framework. If we have news in an hour, which is a guaranteed distribution in a way, not a distribution, but a massive injection of volatility, we're not going to distribute and then distribute. We are going to accumulate and then distribute or manipulate because news is a volatility injection. Not going to get into that. But we're not just going to distribute, distribute, distribute. That is not how it works, right? And same thing after a news event. If we're immediately trading after CPI, we're probably going to have accumulation, right? After 8:30, and then maybe at the 9:30 we'll have a trade opportunity for a rebalance, and we can use these data highs as draws on liquidity. But we don't just distribute, distribute, distribute. So just think of that when you're trading. All right, we have to look at previous price action. We have to look at previous session action, what we've been seeing, and let's think of trading realistically. And let's not FOMO on these big moves. There is so many hours in the week to trade. So we can't get stressed when we see a misdistribution because, again, like I said, whenever there's a big distribution, odds are we're going to get caught in accumulation after that big move. So try your best to avoid that. I know it's tough as a beginner trader. I know we want to have as much fun and trade as much as we can, and you can only trade 5 times a week. It's terrible, I know. We have to do other things. But the reality is it's not going to be good trading. Okay? So I hope this video was helpful. I hope you guys took something away, or I hope you even identified something wrong with your trading or mentioned something you didn't even know was wrong with your trading. That would be the best case scenario, is that if you guys are struggling with your trading and you don't know what's wrong, and this video helped identify a piece of the problem and then solved it, right? Um, like I said, I would highly recommend going and checking out my other videos regarding my high time frame bias. That is also going to go in depth into clearing up the manipulation aspect and the high time frame aspect regarding um, the 2022 model Canada event and how to avoid just pattern trading internally. It's a super clarified and in-depth video of that, so I'd go check that out on my channel. But for now, that's going to wrap up this video, and I hope this was helpful. As always, leave a comment, subscribe, and I hope my mic was alright for this video. If you guys made it all the way, I think it should be. But that's going to wrap it up, and I'll see you guys for the next video.